Howdy, Jacob here. Today we're looking at Chord Energy Corporation in the software industry. 6.8 billion market cap on 6.9 billion enterprise value. Very similar metrics, size of company there based on market cap and then inclusive of debt and cash on hand. They are an independent exploration and production company that acquires, exploits, develops, and explores crude oil. So it's really not a software industry. Should be in the oil, gas, and consumables industry. So that's interesting. Um, Revenue declined very heavily after 20 or to 2020, and then is up an immense amount. I presume that is likely due to just inflation and the cost of those things going up so heavily. And there, yeah, I mean, if you just look at a 1 year basis, it looks absolutely fantastic with the 60 essentially earnings per share, $6 dividend, and return on invested capital 53%. And it looks great from all that. There's not a lot of history. I mean, we're seeing 4 years of data here, but balance sheet wise, 593 million cash on hand with 394 million long-term debt, no short-term debt. So that's not concerning. That's a healthy balance sheet there. And then for their cash flow statement, again, recently looks pretty great. Rolling 12, about 900 million. Last year, 1.6 billion. And then they had some sell-offs, but even still 1.2, but then negative 1.2. It's kind of all over the place here. Where their use of cash is very heavy on the acquisition and reinvestment side, with a little bit going to share buybacks and then a lot going to dividends. So it's really looking like maybe 20% acquisition, at least the last 3 years. We're seeing roughly 20% acquisition, and then maybe 35% dividend, 35% reinvestment, 10% share repurchases. I think that's a pretty fair estimate of the most recent 3 years. But before that, it looks like, yeah, they haven't reinvested till recently. They've they've paid a lot in acquisitions, and yeah, haven't done a dividend since recently, but also weren't making money. So you got to take that into consideration. If they're not making free cash flow, it's hard to do stuff with your free cash flow. All right, so let's start making some assumptions here. This might be a little bit interesting. I would say that I hate to do it, but I'm going to do 0 and 10. So this is saying there's no growth over the 7 years, but that's really saying that I think they got inflated very heavily recently, and I think that might dwindle down. But I will give them some emphasis, or I will give them some push a little bit on margins, because I think that although revenue is going down, they'll be able to become more efficient with what they have. And so maybe let's do 25, 30, and then why did they issue so many shares? Is that their acquisitions? I wonder their shares have jumped so much here. And I don't have an answer. Because they haven't, stock-based compensation is only 58 million, and they bought back 157 million worth. So they might have just bought a company and then taken those shares on. So maybe just, I don't know, 2%. I feel like that's reasonable. And then the dividend paying out 549, I'd say that I'd probably want that to be cut in half, because I want them to be focusing on strategic acquisitions that make sense in increasing cash flow and growing the business, and then reinvesting into yourself in places that make sense to get a high return. I don't want them to be too focused on paying out a dividend at this point in time. And that gets us to a final price that needs to fall 32% before you get a 15% return given these assumptions. I I'm going to change this to 0, saying that, although they may make acquisitions and then the actual business might decline a little bit, um, they're not going to be acquiring businesses for shares per se. Um, that's what the assumption that I just made was, and I think I'm comfortable with that. I think I'm comfortable with all these assumptions. I could easily see you want to go higher on the revenue change in terminal PE value. Just looking at the numbers, though, I feel like when I see a revenue number that jumps 45% and 131% in 1 year, and it's way above what the pre-COVID numbers were. I understand if this were like an airline or hospitality where it's just getting to pre-COVID levels again, then maybe. But here, I'm just like, I just, I just don't see the margins being that big for that long, and it is a cyclical business there. So. Thank you, and hope you enjoy the rest of your day.